Good day, my name is Bianca Haywood and I will be running you through AVI's webinar. Should you wish to ask questions, please type your question into the chat box. I will be answering your questions via email correspondence. Let's take a quick look at what we will be covering today. I'm going to start off with the nature of business, followed by the recommendation, the financial review, a divisional overview, company guidance, and conclude with the portfolio guidance. Let's take a look at the nature of business. AVI is home to South Africa's leading brands, listed on the JSE in the food product sector and centered on the fast-moving consumer goods market. AVI's extensive brand of portfolio includes more than 50 brands. AVI's brands span a range of categories, including beverages, biscuits and snacks, frozen food, personal care, products, cosmetics, shoes, accessories, and fashion apparel. Some of AVI's brands include Five Roses, Freshpack, Coffee House, Frisco, and Ellis Brown in the beverage category, Bakers, Willards, and Provitas in the biscuit and snacks categories, I&J in the frozen food categories. AVI's beauty and personal care brands include Yardley and Coty. Great international and local fashion brands in the AVI stable include Spitz and Green Cross, just to name a few. Now moving on to the recommendation. AVI is a high-quality company with attractive operating margins and a consistently good return on equity and historically healthy cash generation. The operating environment is expected to remain bleak over the short term. However, the group has a strong portfolio of brands which are largely defensive in nature. The group's strategies to mitigate margin pressure have proven effective. This will become increasingly difficult to sustain as the weak economic conditions leads to a fight for market share in a saturated market. We feel that the share is fully valued, trading at a forward PE of 17.9 times, slightly ahead of its long-term average. Now moving over to the financial review. AVI delivered a sound performance in a challenging trading environment. Revenue increased by 8% to 13.2 billion, mainly driven by higher prices to offset the weaker rand and higher raw material costs. Volumes came under pressure as constrained consumer spending persisted. Gross profit rose 8% to 5.8 billion, rendering a slightly lower gross margin of 43.7%, down from 43.9% in 2016. The strengthening of the rand in the later part of the year helped to ease cost pressure in the second half. Adjusted operating profit rose 11% to 2.4 billion, resulting in a higher operating margin of 18.1%, up from the 17.7% in 2016. Profit before tax rose 10% to 2.3 billion, as improved results from I&J Australian joint venture was partly offset by an 18% increase in the net finance costs. A final gross dividend of 243 cents per share was declared, which combined with the interim dividend of 162 cents per share brought the full-year dividend up 9.5% to 405 cents per share. Cash generation was impacted by higher working capital requirements relating to the lower raw material creditors due to the timing differences compared to the previous year. CapEx amounted to 546 million, with investment into manufacturing capacity, efficiencies, and retail outlets. Now moving over to the divisional review. Food and beverage revenue made up the bulk of the group's operations and consisted of Entice Beverages, Snackworks, and I&J. Food and beverage revenue contributed 76% to group revenue and 75% to operating profit. Food and beverage revenue rose 9% to 10.1 billion, while operating profit rose 12% to 1.8 billion, resulting in a higher operating margin of 17.8%, up from 17.3% in 2016. Fashion brands consisted of personal care, footwear, and apparel. Fashion brands accounted for 24% of the group's revenue and 26% of operating profit. Revenue rose 5% to 3.1 billion, while operating profit grew by 8% to 607.5 million, resulting in an operating margin improving by 40 basis points to 19.5%. Now let's take a further look at the food and beverage business. Enticed beverages contributed 28.5% to revenue and 31% to operating profit. Revenue increased by 10% to 3.8 billion, with tea, coffee and creamer achieving revenue growth. This was mainly driven by price increases, which helped to offset the impact of the weaker rand on raw material costs. Five Roses and Freshback tea brands delivered a commendable set of results, while Hug in a Mug specialty coffee grew strongly. Sales volumes were impacted by constrained consumer spending and higher prices. Gross margins came under pressure due to increased competition. However, some relief on margin pressure was experienced in the second half of the year on the back of the stronger rand. Operating profit rose 11% to 735.1 million, supported by well-controlled costs. Higher tea and coffee profits were partly offset by lower profits in creamer. Creamer profit was impacted by increased competition, which limited price increases. However, the creamer profit started to gain traction in the second half of the year. The operating margin improved by 30 basis points to 19.6%. Now moving on to the next slide. Looking at the group, we can see that the group really maintained its market share with the exception of creamer. Creamer market share declined due to aggressive competitor pricing and new pack sizes. Now moving on to the next division, Snackworks. This division contributed 30% to revenue and 28% to operating profit. Revenue increased by 9% to 4 billion, mainly driven by higher prices. Biscuits revenue rose 7% on the back of higher prices as volumes declined by 4%. Snacks revenue rose 13.5% with a 6% increase in volumes. Potato chip volumes were suppressed by constrained potato supply during the first half of the year. Gross margins were impacted by higher raw material costs. Operating profit rose 9% to 666 million, supported by well-controlled costs. The corn portfolio continued to grow volumes and contributed positively to the higher operating profit. The operating margin improved 10 basis points to 16.8%. Now moving on to the next slide. In this graph, we can see that Snackworks' market share was slightly lower across the division. Now moving on to the next division, I&J. I&J contributed 18% to group revenue and 16% to operating profit. Revenue rose by 9% to 2.4 billion, supported by price increases and the positive impact of the weaker rand on exports. Sale volumes were down 7% due to the illegal strike in August 2016 and lower quota. Operating profit grew by 18% to 389 million, supported by improved processing performance. The illegal strike reduced operating profit by 25 million. The operating margin improved from 15.2% to 16.5%. Now moving on to the next slide. Freezer vessel catch rates were higher, while wet vessel catch rates were lower. The 2017 quota were reduced by 3,344 tonnes due to a lower total allowable catch rate and a lower allocation of inshore rights. Now moving on to the next division, Personal Care. Personal Care contributed 9% to revenue and 10% to operating profit. Revenue increased by 9% to 1.2 billion, with a strong performance from the core ranges and innovation. Revenue from own brands increased by 11%, driven by a combination of higher prices and volume growth. Volumes rose 3.5%, with increases in fragrances, roll-on and body care products. Gross margins were impacted by cost pressure due to the weaker rand and lower commissions from Coty. Well-contained costs supported an 11% increase in operating profit to 241.5 million. The operating margin increased from 19.9% to 20.2%. Body spray market share improved slightly from 37.2% to 38.7%. Now moving on to the next division. Footwear and Apparel. This division contributed 14.5% to revenue and 15% to operating profit. The revenue rose 3% to 1.9 billion, while operating profit increased by 6% to 366 million, resulting in a higher operating margin of 19.1%, up from 18.6% in 2016. Let's take a further look at the footwear and apparel business. Spitz contributed 93% to the footwear and apparel operating profit and reported a 2% increase in revenue as higher prices helped offset lower footwear sales volumes. Footwear sales volumes declined by 14.4% as fewer shoes were cleared on the sale compared to the previous year. Spitz continues to experience growth in lay-by volumes. Lay-by volumes now accounts for 24% of unit sales, up from 18% in 2016. Spitz had a much stronger second half, supported by lower selling price inflation on the back of a stronger rand. Core footwear brands performed well. Gross profit margins improved on the back of strict cost control. Operating profit grew by 6% to 340 million, supported by a much stronger second half. The operating margin improved to 22.7%, up from 21.8% in 2016. Now moving on to the next. Looking at the graph below, we can see that the group fairly maintained its market share and margins. Now moving over to the next division, Green Cross. Green Cross revenue rose 9% with retail sales up 15.5%. Wholesale sales declined by 5%, reflecting the customer's preference for higher priced footwear from branded stores. Gross margins were impacted by sustained discounting by competitors and constrained consumer spending. Operating profit declined by 2% to 26.8 million, resulting in a lower operating margin of 7.2%, down from 8% in 2016. A 108 million impairment has been made against the Green Cross trademark. During the year, 4 new Green Cross stores were opened and 6 stores refurbished. Now moving on to the company prospects. The trading environment is expected to remain challenging as consumer spending remains constrained and competition continues to intensify. Accordingly, the group will continue to focus on the appropriate balance between prices, volumes, and margins. The group has reviewed its cost structure to improve overall efficiencies. AVI International will continue to focus on growing the group's brand in export markets. Footwear and apparel business are expected to benefit from the store refurbishments and growth in the trading space, notwithstanding increased competition and higher markdown by competitors. I&J's performance remains dependent on the exchange rates and catch rates. Improved sales mix, higher export prices, and a recovery from the illegal strike should support and improve performance from I&J. The group will remain cost-conscious and continues to evaluate opportunities within its current portfolio and through acquisitions. In conclusion, the group believes it's well positioned to compete in depressed market conditions. Now moving over to the portfolio guidance. AVI has a weighting of 0.63% in the caps wicks. We maintain our underweight guidance and would not recommend exposure at this stage. That concludes my webinar. Should you wish to place a trade, please contact our trading desk. Thank you and enjoy the rest of your day.